Ever wondered why some stocks stay under the radar even when the numbers look solid? That's exactly what we do at Insightful Value. We dig into undervalued companies, strip out the jargon, and lay out the facts. And today, we're looking at Neuca, a company whose stock price seems oddly low compared to what's happening under the hood. This review is for informational and educational purposes only and is not financial advice. Neuca is one of Poland's largest pharmaceutical distributors and healthcare service providers. They don't just deliver drugs, they power the infrastructure behind pharmacies, offering logistics, wholesale services, and even their own private label pharmaceutical products. If you live in Poland, chances are a medicine you pick up at the pharmacy has passed through Neuca's system. So, what's up with the stock? As of now, Neuca's share price has declined significantly from its 2021 highs. On paper, that might look like a red flag, but for value investors, this could be an opportunity. Neuca has a strong market position, a wide distribution network, and a growing portfolio of services. Despite the stock's recent weakness, the fundamentals aren't falling apart. In fact, revenue has continued to grow steadily, supported by rising demand for pharmaceutical distribution and healthcare services. Their operating margins are thin, which is typical in the distribution business, but they're stable. What makes Neuca interesting is its ability to maintain consistent profitability in a highly regulated, low-margin sector. Earnings per share have held up relatively well, and the company continues to pay dividends, albeit modestly. Over the past 5 years, Neuca's dividend has grown, reflecting a steady commitment to rewarding shareholders even in a volatile market. In 2024, Neuca continued to invest in healthcare clinics and diagnostics, expanding its vertical integration and potentially boosting future margins. They're not just sitting still, they're building a long-term ecosystem around patient care. That's not something every pharmaceutical distributor does. Now let's talk risks. First, the low margins leave little room for error. A small disruption in logistics, regulation, or pricing can hit earnings fast. Second, the Polish healthcare market is heavily influenced by government policy. Any shifts in reimbursement rules or pharmaceutical regulations can impact Neuca's profitability. Also, competition is tight. While Neuca has a strong position, it's not untouchable. So, why invest now? If you believe the market is underpricing stable, essential businesses, Neuca could be worth a closer look. It's a solid operator in a sector that doesn't go out of style, and the current price might reflect more pessimism than reality. Why not invest? Well, if you're looking for fast growth or fat margins, this isn't that kind of play. It's slow, steady, essential, and some investors might find that boring. Others might call it safe. At Insightful Value, we focus on these kinds of stories, underappreciated companies with real-world impact. We provide in-depth analysis without the fluff. Whether you're experienced or just starting out, we break down complex data and give you straight-up insights you can actually use. You'll find more about Neuca and other undervalued opportunities at insightfulvalue.com. If you found this helpful, hit like, subscribe to the channel, and check out our latest insights at insightfulvalue.com.